All right, we're live. We're looking at Tesla after its earnings report. Let's get to it. As you can see, Tesla's down about 2.5%, which isn't that big of a move for such a volatile stock. So one of the things I've been looking at is actually an iron condor 2 days after earnings. So earnings was today, Monday, the 26th, I believe today is 26th. We're going to open up a position on the 28th, which is Wednesday, I'm thinking, an iron condor. We're going to sell the 35 delta calls and puts and then buy the 15 delta calls and puts behind that. So let's look at the Tesla options chain. I'm in Robinhood. We're going to do 30 days out from today, from 2 days from now, which is going to be May 28th. Okay. So stock price is right around 720. So I was looking at this before. To get to the 35 delta mark, we got to go to right about, let's see, 800. So that's going to be we're going to sell the 800 call, and then we're going to buy the 15 call behind it, 15 delta call behind that. 19. So looks like the 900 delta call, the 15 delta call is 900. The strike price is $900. Okay. So we just bought that. And now let's handle the put side of things. Okay. So we're going to do the 35 delta put. So that's going to be 700. We're going to sell 700. And then we're going to go ahead and buy the 15 delta right behind it, which is, let's keep going. Okay, 610. All right, you can see that's a pretty fat credit. It's $4,000. The trading plan would be to cap any losses or gains at 40%. Okay. And if we go, and I'm using CML Viz, which is a back tester. It's called the Trade Machine. It goes and back tests options. And here's the historical returns. The average win was about $5,700. Average loss was about equal to that. But if you look at the historical win rate, it's about 83%. So let's go back here. So yeah, this would be the trade, and this is going to open. We're going to open this up 2 days from now, so a lot can happen. The price can move a heck of a lot. Basically, the idea is after earnings, right after earnings, a day or the next 2 days, there's still a lot of volatility. So we wait 2 days to open up the iron condor. Okay, and if you know anything about iron condors, you want to sell an iron condor in a high implied volatility environment so that the implied volatility can drop and your options, the iron condor, will be worth less and you can profit because it's a net short position. We're receiving a 43.45 credit if we were to get a fill on this. Okay. So one of the things I like to do is, I'll check out the chart. I'm not super technical. I sort of use the historical back tester, the Trade Machine, to get a lot of my trade ideas. And if I see any major red flags, I won't do it. But here, the only thing I see is that there could be we were in a little bit of a squeeze here, meaning that we got some price consolidation. You can see the Bollinger Band is expanding a little bit, but we're still pretty tight. So the only thing is with the iron condor, the way you can lose money and lose money quick is if the stock price just went on a tear and went beyond that. I think our $900 strike was, our $900 strike. So another way to visualize this is if I'm going to go to E-Trade and visualize our profit and loss diagram. All right, we're going to E-Trade Options Analyzer. There's some better counts, better software programs. I think TD Ameritrade, Thinkorswim. Thinkorswim's got some pretty advanced stuff. So let us enter Tesla. We're going to add that. Select a strategy. We're going to do the Iron Condor, wherever that is. Here it is. And let's first start by setting our expiration dates. Boom, all 4 expiration dates are changed. Now, remember, for the call side, we bought the $900 one. And I believe we sold the 800. We'll confirm in a bit. Let's see what our strikes were again. Here are our strikes. Sold the 800, bought the 900 call. Now for the puts, we sold the $700 put. $700 put. And 610 put we bought behind that as protection. Okay, now let's analyze. All right, so here's our profit loss diagram here. So it looks like if the stock was to drop to $658, that's when we would start to lose money. As long as it stays in between that price and as long as it doesn't go above $841 to the upside, by expiration, we're going to make money. And let's look at our max profit. The max profit is going to be the credit received. So that's going to be if we were to sell this for $41.32, we'd receive that whole credit. So that's something to keep in mind. If we were to move to the upside, it's something to keep in mind. Now, sometimes I like to, you can put a little bit of a broken wing tilt on this. So actually, if we were to, we're selling the we're selling the $800 call. So if we were to take and move this a little bit forward, so now instead of buying the $900 call, we're going to buy the $880 call. Now watch how this is going to affect this part here of the diagram. So that shorten it a little bit. Let's do a little bit more drastic. So let's do 820 and see how that affects us. Now, as you can see, now if it goes up, we're going to have tremendous upside here. But if it goes down, we could potentially lose $6,000, over $6,000. So that's just something I was just playing around with. But I think I'm going to leave it at the 900 strike, which was the 15 delta strike here. So, yeah, that's something to consider coming on Wednesday. All right, so Wednesday I'll upload again and see how we're doing.